Yeah, hello again. Now let's go on a bit with that small little lecture on international taxation. And as you know, we are still in the introduction, the basics, which you need to understand a bit about tax matters in international scale or surrounding. Let's talk a bit about things which affect you in everyday life. For example, the calculation of the wage tax. The examples which I bring forward are simplified and are fictitious. So what I want to tell you here is just how it works, and please don't take too much care of the details. So the computation of the wage tax would work this way. You know it's a prepayment for the annual income tax which you owe, and it's for the wages of workers or of any employed person. The employer has to calculate the probable annual income tax for that worker, has then to calculate the necessary prepayment, and as there are millions of employers and several of them would probably get it wrong, everything is regulated under the law up to the smallest detail, naturally. So imagine how it works. Let's think about the basic principle. Imagine you earn 2,000 euro a month. Then your expected annual income is naturally 12 times 2,000, so 24,000. This would lead to a total income tax for the year of, let us imagine now, 4,000. This means if we make monthly prepayments, then we need probably 4,000 divided by 12, that is 330 euro approximately, in order to save up enough money so that in the end we have made sufficient prepayments. So that would mean your employer calculates your net wage as 2,000 minus the wage tax of 330. So only a net income of 1,670 will remain. By the way, in Germany, that's only half of the truth, because your employer also has to deduct your contributions to the social security system. So from that 1,670, there will be some other deductions for non-tax purposes too. That's not our problem at the moment. So wage tax just works this way. At the end of the year, then you compute the total income tax due for the year with the final data, and then you compare the total prepayments, and it either gets a refund or a final payment will be due if you underpaid, which might happen in very rare situations. So wage tax and all the classifications which you get attributed when it comes to the wage tax classes is only preliminary. It's only a prepayment, nothing more. So the final tax declaration always consists of offsetting the prepayments against the actual tax amount. Imagine now you worked only for 1 month as a student, so 2,000 euro. Your employer was nevertheless forced to prognosticate an annual income of 12 times 2,000, because nobody knows if you take up other jobs in the rest of the year and so on. So 330 euro were prepaid for that single month. Now at the end, you had an annual income of 2,000. Up to 9,700 and a bit are completely tax-free, though the final tax owed by you for that year is 0 euro. You prepaid 330, so you get back the whole 330. Oh. Another example how it works. Imagine the wage tax for January is 2,000. The wage for January 2,000. So again, we prognosticate 12 times 2,000, that is 24,000, so a prepayment of 330. Now, in February, you think a better job might be fine, and you find a better one, at least a better paid job. Now, from now onwards, your wage is 3,000. So your employer just calculates 12 times 3,000, 36,000. Now, naturally, that's a bit wrong because in January you earned less, but your employer first doesn't know. And second, the wage tax rules must be simple. And so it's always demanded that you just have to take the actual salary of this month by 12, and this is the legally demanded estimate for the complete year. Nobody is allowed to deviate. So even if your employer knows that you earned less in January, well, everything is now 3,000 times 12. Okay, 3,000 times 12, that would mean a total tax of 7,430 for the year. That's again a rough estimate. I believe I calculated this a few years ago, so it's probably based on the tariff of 2017 or 2018. So at the moment you will get a slightly different, probably lower result. And the prepayment now must be 1/12 of 7,430. That would be 619 euro. The strong increase goes back to the progressive rate. With 24,000 you are still rather poor. With 36 you are already a bit wealthy, and so your tax rate has strongly gone up in the meantime, and that explains why your tax nearly doubles here per month. Well, so from March to December you pay 619 every month, and the final computation now would be your total income for the year is 35,000. We have, for reasons of simplification here, ignored all deductions for deductible expense, all standardized lump sum deductions, and so just imagine it's 35,000. Then according to the tariff you owe 7,090 euro. Again, that is some years ago. Now let's add up all the prepayments. You prepaid 7,139, so there will be a refund due of 49 euro, and the surplus, this surplus will be refunded naturally. So that is how the wage tax system exists. In other countries they have similar systems, because everywhere you have the problem. If the people get the full money at hand, not everybody of them thinks about the necessary savings, or thinks about putting aside the necessary amount to pay the income tax at the end of the year. So if the state does not want to lose a huge amount of money due to insolvency of people, or does not want to imprison half of its population for non-payment of taxes, then you simply have to force people into a prepayment system. And the best thing, employers usually know how to cope with bureaucracy. So the approach that the employer gets the duty to make the prepayments out of the salary exists with variations in many other states too. In England, for example, I know there is a pay-as-you-earn system, although I do not know the details. In the US, there is also some rule which I do not understand in the details, or don't know the details about, that employers also can be asked to make prepayments in the name of the employees too. So we have such a system very often. Other people have probably difficulties with prepayments because business owners do not earn a regular income. You don't have a constant flowing income, and you can't ask the business partners of the business owner to make prepayments. There are too many of them. and you can't treat every payment as a kind of profit. So here you only have the choice or the option to base prepayments on an estimated expected annual profit. Indeed, in Germany it works this way. The estimate is the profit of the last year which was assessed to tax, so usually the previous year. And if the owner can already foresee that the current profit this year will be far lower, then you can inform your fiscal office and apply for a decrease in your prepayments. This is usually possible. On the other hand, naturally, if you pretend only that your annual profit this year is lower than last year, then it would be a wrong information given to fiscal authorities. It would bring along a tax advantage for you. Lowering of your prepayment means you have to pay the rest later. And that would be misinformation, which leads to a tax advantage that would already be tax fraud. So people will only apply for lowering of their prepayments if they are really, really sure that their profit goes down. Final payments here are very, very often because business owners do not have constant inflowing cash and outflowing cash. So the profits always are not constant. And so you very often will have a final payment or a refund. When you have to make your final tax declaration and you have income from several sources of income, then naturally, as I told you already, you are not assessed individually with each type of income or so, but everything has to be declared, everything is added up, and all the prepayments which you made are added up and compared with the total tax which is due. So if, for example, you have a job as an employee, but in your leisure time you run an online shop where you have an own business, then you would have income from business to declare and income from employment from your regular job. And the prepayments you made would be wage tax and the business owner's prepayments which you made every 3 months in the year. So everything would be added up and then compared to the prepayments which you made. The only exception is since 2009, income from capital has been separated from the rest of the total income in Germany and is taxed separately with a flat rate of 25%. And very often there we have a prepayment made by a bank or by a company which pays you a dividend, which is exactly 25%. So that in that case, the final tax and the prepayment automatically are identical, so that in certain circumstances you are even allowed not to mention these income events in your tax declaration. Only when the prepayment, the capital income tax, was not paid by your business partner, then you have to declare it. Yeah. So how is income now computed? Well, that's different under German law. It's a peculiarity which goes back to the 1890s. At that time, there were different rules for the income definition introduced when it comes to the different types of income. The first three types are taxed on the basis of the profit, and profit is defined as every realized, so finished gain or increase of property. So current revenue minus current expenses plus gains from selling the underlying property, which you use to produce these current revenues and expenses. So a business, if it sells property, is always taxable with the gain from the property too. So if you sell a piece of land which you used years for running a factory on it, it is part of your business property, and so when you sell it later, be it after 5 years, 20 years, or 150 years, the gain from selling will be taxable too. Now, with the last 4 types of income, 4 to 7, employment, capital, lease, and rent, and other, in theory at least, the tax base is called the surplus, and the surplus in theory only covers current revenue minus current expense. But selling the property, the underlying property which you use to produce these things, would be not taxable. Naturally, the fiscal ministers over time tried to get a bit of that tax-free amount. So more and more exceptional rules were introduced that in the area of private property, that is the property which is used in the income types 4 to 7, also the one or other gain was declared taxable. For example, if you own a house which you use to produce lease and rent income, then if you sell it within the first 10 years after acquisition, that is declared taxable. Or if you have a capital investment there, the principle has even nearly completely abolished since 2009. When you sell a capital investment, the gain from selling is also always taxable in Germany. Yeah? But the difference between business property and private property is still very important, and it influences strongly the behavior of people in Germany, especially when it comes to houses and other buildings. If they are held as private property of the owner, then selling them will be tax-free after 10 years. If they are held as business property of the owner, then they are taxable when they are sold. Now, the problem is you can't opt for the one or other treatment. If you use your property for running a business, it's automatically business property. So a house owner who runs a hotel has to pay taxes when going on retirement. That house owner sells that building with a gain. Because the hotel was a business, he used it for his business, and so selling it is taxable. That, by the way, leads to some strange arrangements. There are clever guys who open a hotel, but the building is not bought by them, but the building is owned by their spouse. Now, the spouse does not run a business, husband does. Husband gets the hotel building and pays rent for it. And spouse only lets the house for rent, but doesn't run a business. So for spouse, that house is a private investment and can be sold then after 10, 20 or 30 years without having to pay taxes on the gain. Small hotel owners will probably use that recommendation. Very often you see also that big hotel chains in Germany do not own their hotel buildings, but that private investors own the buildings and let them to the hotel chains, and the chains, in order probably to give the hotel owners the chance to make a good profitable investment with the chance to a tax-free gain after 10, 20 or 30 years in the long run, the hotel chains are rewarded by the owners probably just in the way that the hotel owners charge them a rent which is a bit lower than the own cost of the hotel chain would have been if they erected the building with their own money and owned it themselves. So these differences sometimes have importance. Well, an interesting thing is naturally if income also can become negative. And the answer is yes, naturally. If your property goes down due to income-related reasons, then it can become negative. Income is business revenue minus business expense, or revenue minus expense in the other types of income. And that is just automatically and strictly computed. And so if a negative outcome results, then this is also added up with the other 6 types of income. So your total of your income goes down if you have losses from one of these sources. Now, naturally, people would try to declare their private leisure time activities where you spend your money as a business, as an unsuccessful business. So a private hobby, you would like to bring it into your tax declaration as a business. Now legislation and jurisdictions say, no, that's not possible. Income can only be an activity or result from an activity where the intention is that over the total period of time, from the beginning to the end of that activity in several years, you want to achieve and have the chance to achieve realistically a total profit or a total surplus, which must be taxable. So activities which only can lead to a loss are not regarded as income activities, not relevant for your tax declaration. They would be regarded as a private hobby. So this would not be allowed to declare as a loss. On the other hand, when you genuinely intend to start a business, you rent a shop building, for example, in December, and then begin to fill the shelves and so on. Naturally, you will probably work through the whole of December with the preparations and will be busy with them. You have already to pay for 1 or 2 employees. You have to pay for the paint for the walls. You have the rent, but no customer yet because your shop has not yet been opened. So it's clear in December there will be a loss, a starting loss simply. Now in January, when you are finished, 2nd of January, you open your shop and surprise, now customers flow in and in a wild orgy of consume. They buy your shop empty and you drown in money. Here you see, naturally, without the investment in or without the expense in December, it would not have been possible to have such a nice shop, so attractive to the customer. So naturally, the legislator is relatively wise in allowing that your December result can be deducted, because that makes it possible to earn so much money in January and the next months. To say, no, we do not allow you to set off losses against the rest of the income would make your investments rather more risky. So in all cases, even if after December your shop fails, burns down due to an unhappy event or so, even then, if it was a genuine investment which just went wrong and the intention clearly was undisputed and undisputable that you wanted to achieve a total taxable profit over time, then you could have set the loss with the rest of your income. Because the idea is, very often, if somebody wants to start a business, well, that's risky. 2 fail and 1 has an enormous success. But if you tell all the 3 you cannot offset your losses, you will have to probably go bankrupt then, or you will have to finance that all from your net income. Then the risk becomes for them considerably higher, and the 3 don't start a business, and so the 1 really mega successful business will never happen, and then the state never gets that additional source of income tax. And so being too restrictive there would backfire. The only restriction which they have is if there is this, the suspicion that it might be a private leisure time occupation that you do not seriously intend to achieve a total taxable outcome over the overall period of time, then they refuse to accept the loss as genuine income. In all other cases, they accept it because they say, okay, if you risk 100,000, for example, well, you will have good reasons for it, and you are the one who can judge the chances and risks best. And if you fail, okay, you lose 100,000, we only lose, let's say, 30,000 in taxes. So you are still the one who is hit most by the loss, so we can trust your judgment here. Under which circumstances can expense in general be offset from the tax base? Here's the same problem. Private leisure time, that occupations, no. Your income is what makes you richer and not what you spend for consume. So expense only is relevant for calculating your profit or surplus if the expense was made in order to achieve revenue. So the definition in the law is business expense is everything which is caused by business. So where the reason is business. Now, when there is also a private motive in the background, so-called mixed expense, then you have to find out which part of the expense is exclusively caused by business, because here the law is relatively cautious, by the way, not only in Germany, in most states, or near perhaps even all states of the earth. They think, okay, if people can tell us that their private hobby expenses or their consume expenses are business expenses, then there will be no taxable income left over. So we want to avoid that. We only accept as business expenses which are exclusively caused by business. If a private motive also comes into play, private motive here means consume related motive, then it's spending income and not expense in order to generate income. So you have a two-step test. First, can I see a cause by business? Second, is there also a relevant private or consume-related motive in the background? If that is the case, if that cannot be disproved, then the expense is not a business expense and it's declared not relevant. Here you see it again. For example, you can this then always apply to find out if you can deduct things in your tax declaration. But naturally, you should also read what you don't read here. Expenses caused by business is sufficient. There is no requirement that expense must be necessary. There is no requirement that it must be restricted to the necessary amount. You can waste money if the only reason you waste it is a business reason. That's all allowed. So the only thing you have to fear is private consume motivation. That spoils deductibility. If we go for examples, a business owner buys a book on accounting and he hopes he can use that for business. Price €60. Opens the book, nothing new, not helpful. Also €60 deductible expense. Let's make the test. Was it caused by a business motive? Yes, he hoped for a good business outcome. Now, it failed. Second thing, is there a private consume-related motive imaginable when it comes to buying a book on accounting? Well, ask yourselves, would someone of you ever buy a book on accounting as a leisure time occupation? Can you imagine somebody lying in the sun and the pool somewhere in Turkey and saying, "Hey, darling, I want to have a book on accounting, so when you go and buy your next crime story, bring me a book on accounting. I always wanted to inform myself about accounting. I found it so great." If so, keep the address of that person if you know such a person, because that would be a very rare guy or girl. Accounting is usually regarded as horrible and uninteresting by all persons who have nothing to do with that. This is something which nobody deals with outside business. So definitively business reasons and no private reasons. So that is a business expense and deductible. Huh? Business owner makes the experience that whenever he arrives at a meeting with an old and second-hand car and old-fashioned clothes, he has difficulties to achieve a good fee per hour for his consulting services. Because then the customers think the guy is poor and needs the money, so we can negotiate hard on the hourly fee. So a business consultant says if you want to push through without a big opposition, high fees for your customers, then wear expensive clothes and buy a luxurious car to show them I am wealthy, I'm successful, I do not need your order, you have just to pay my fee or let me go. Now, this is a very, very compelling business motive. So we have a cost by business. Now, on the other hand, ladies and gentlemen, we must admit that buying and driving a luxurious car also has a private background. Many people would like this also for consume motives. So we have here mixed expense. There is a business motive, but there is also a private consume-related advantage in the background. Undeniable, so surprise. This is probably spoiled. At least the cost for the clothes are entirely gone. And with the car, one would also have to debate at least if buying a too luxurious car can still be regarded as entirely caused by business. Naturally, by the way, with the car, you could first make a calculation privately driven kilometers, business kilometers, but if you drive a Rolls-Royce for business travel, then that also affects probably the business kilometers that you drive them in a Rolls-Royce, because no reasonable person probably does this. Their private motives and business motives also mix for the business kilometers, so there might be problems at hand. The basic rules apply for employees too. You have again the two-step test. So if expense was caused by the wish to generate income, then irrespective of if you have success or not, it's deductible expense under that type of income. Now imagine a student gets 4 invitations for a job interview after finishing studies. Traveling to the interviews causes costs of 500 euro and he has to pay these costs for himself. Can he deduct that in the tax declaration as income-related expense? And the answer is, was it caused by the wish to now or later get a job? And the answer is yes. Is there any material, so important, private motive in making a journey, let's say to Berlin, dropping into a firm, having a job interview and taking the next train home? And the answer is no. This is not a holiday. So not mixed expense, entirely caused by business motives. So that is deductible expense. Yeah. Okay. Then another peculiarity which one should know when it comes to German taxation is how married couples are taxed. And this, ladies and gentlemen, is, I think, again, a topic for the next video. So let's have a small break here and let's wait for the next video on that small chapter. Thank you for watching and goodbye till next.